What are some of the big debts that you're really seeing out there that are hampering people from being able to get mortgages?
Credit card debt.
Wow.
Credit card debt. Focus on the credit cards, get them paid down or paid off. We need to definitely lower credit card debt. The standard bills are a car payment. Everyone typically has to have a vehicle and they're going to have a car payment. Mm-hmm. But those credit cards, if you do not need them, get rid of them. If you can't afford to eliminate them from your debt to income ratio, get rid of the credit cards.
Have you ever wanted to get involved in real estate development but didn't know where to begin? Do you think real estate development is only for the large hedge funds or major corporations, the big guys? Or have you done some development in the past and are looking to scale up? If you answered yes to any of these questions, then this podcast is for you. Welcome to the W.I.R.E.D Wealth and Real Estate Development Podcast. I am your host, Nick Smith. Get ready to have your mind blown and rewired as we discuss all aspects of creating wealth and real estate development. Good day, everyone. This is the W.I.R.E.D Podcast, Wealth and Real Estate Development, and I am your host, Nick Smith, and this is episode 17. Want to welcome everybody. If this is your first time watching the podcast or viewing us on YouTube, I definitely want to appreciate you for taking time to watch this episode or even listen to this episode. Feel free to like, share, subscribe. Definitely want to thank everybody that has ever downloaded an episode, has ever looked at an episode, has ever listened to an episode. Definitely appreciate the support and encourage you guys to spread the word so we can expand this knowledge and word of creating wealthy communities, wealthy individuals, and wealthy families through real estate development. Do have a special guest with us today, a gentleman by the name of Aaron Stokes. Aaron is a mortgage lender with First Financial Bank. As you all know, if you know some of my history, I started off primarily as a residential real estate broker, and Aaron has definitely been one of my trusted mortgage advisors and mortgage lenders and mortgage partners in this business. And if you are selling or looking to develop, single family homes, condos, or, whatever, if you're looking to sell those, you definitely need to know basic mortgage parameters. What are some of the nuances that might be different in selling a new home versus an existing home? A flip is different than a new construction property, and we'll touch on some of that as well. But Aaron, my good friend, how are you today?
I'm pretty good. And yourself, Nick?
Man, I'm doing well. Definitely appreciate you taking time out of your schedule to join us today. And if you can, feel free to give my listeners now just kind of a brief introduction of who you are, where you're from, what you're doing, and even where you're going.
Sounds great. I'm Aaron Stokes. I'm with First Financial Bank, a mortgage loan originator. I've been with the company, First Financial, for about a year now, but I've been in the business for approximately 19 years. I started off as a mortgage broker. I got licensed through the state of Illinois. And then as I was working on the mortgage broker side, I became a real estate agent for the state of Indiana. So did a little bit of both early on until I decided to make some changes because of the industry changing at that time around 08, 09-ish. And I decided to go into mortgage banking. So since 08, 09, I've been strictly a mortgage banker working for credit unions and banks throughout Northwestern Indiana. So my primary area of servicing through my career has always been basically in Northwestern Indiana and borderline the Illinois, Chicagoland market.
Got you. So you started off as a broker, transitioned into we started off as a real estate broker or mortgage broker.
Yeah. Licensed as a loan officer over in the state of Illinois.
So that was almost 20 years ago. You said 19 years.
Yeah.
So how has the mortgage industry changed from that time, from 20 years ago to where it is now?
It's changed drastically. I've seen it get a whole lot better, and I've seen it change for a decrease in value.
Hmm.
Right now, I would say that things are a little bit more challenging because the inventory out there for home buyers, it's not as much. So the focus now seems to be on new construction. So that's where it's at. In fact, I met with some builders yesterday, and they were just basically telling me, Aaron, right now, just being able to go buy an existing property has been very challenging. So we've been busy putting up new homes in the area.
Mm-hmm. Mm-hmm. No, and that's encouraging, especially for those that want to get into development, because what happens and what has kind of contributed to this lack of inventory, and I mean, that's probably one of the phrases that has been mostly used in the last couple of years is inventory shortage. But what has happened is you have a lot of people that have been in their homes for a while, have a lot of equity, and they don't want to sell their home, because right now, if you sell your home, you more than likely are going to get less home for the price that is going to cost. You're going to get less home than what you're in right now. So some people are just electing to stay in their homes, and that's where building does come to play. Our nation never really caught up to the building demand after the 2008 era. I mean, a lot of your builders went out of business and building slowed down. So that's definitely encouraging to hear that, new construction is still, a viable product, and people are still looking for, new construction. Given your background, as a mortgage broker and now, in the mortgage industry, what would you say kind of right now is if you had to boil it down to, maybe the top two or three instances or top two or three criteria, what would be kind of the top two or three things that are keeping people from qualifying for mortgages right now?
The price of
Price.
the homes and interest rates. So it's making it quite challenging for some people in certain areas to be able to purchase because what they qualify for, it just really doesn't exist for based on the amount that they qualify for. Finding a property that meets their needs has been challenging.
Hmm. Hmm. Well, that definitely is. I think that's across the board. That's not just in our area. Because correct me if I'm wrong, but the neighborhoods that you service or the areas that you service, would you say that those kind of are more of the affordable areas, affluent areas? What classification would you say?
I would definitely, I mean, I cover all areas, but
Right.
my focus is on the affordable areas. And just even the affordable areas, the prices of homes have gone up to the point where it's making it a little different or a little bit more for them to qualify for a home. Like I said, that meets their needs.
Right, right. And it is, and that is a conundrum, really, because a lot of these affordable areas do need new product. They need new homes. In our area, I think about the three cities that come to mind are, East Chicago, Gary, Hammond. Those areas, for sure they have older housing stock. And, if you had some newer, housing, I definitely think there would be some demand, but the price to build these homes, have gone up. Materials have gone up, labor has gone up, in these areas, unfortunately. And it is starting to change. I'll say that especially about Hammond, because I've seen some things in Hammond where prices, are up there. But as a whole, you have not been able to build and sell $400,000 to $500,000 homes in those neighborhoods. You just have not. So that's where I think some of our government regulations and things like that can have some influence on the costs of putting up these homes. Because there are a lot of soft costs. I mean, just permit fees and just various fees, that the government can play a part in, just increasing some of the supply in some of these areas. So as far as financing of new construction in homes, financing, and we're talking about the end buyers, because I heard you say kind of the two biggest impediments right now for people qualifying for homes is the price and the interest rates. And those kind of, I won't say they're synonymous, but they do go hand in hand, because when the interest rates were were 2 and 3%, yeah, a person could potentially afford a little bit more than now that the interest rates are 6 and 7%. But are you seeing a lot of issues with debt to income ratios? And if so, kind of what are some of the big debts that you're really seeing out there that are hampering people from being able to get mortgages?
Credit card debt.
Wow.
Credit card debt. Focus on the credit cards, get them paid down or paid off. We need to definitely lower credit card debt. The standard bills are a car payment. Everyone typically has to have a vehicle and they're going to have a car payment. But those credit cards, if you do not need them, get rid of them. If you can't afford to eliminate them from your debt to income ratio, get rid of the credit cards.
What about student loans? Because I've heard student loans have been an issue as well.
Student loans plays a huge part, but you have to see what you qualify for. There are opportunities with student loans that allow for you to go into certain programs that may be beneficial to you for when you're purchasing a home. The student loans will allow for you to just do something differently. Like I know of a program they have called the income-driven repayment plan. So It's based off of your income. And depending on which loan product you qualify for, that can be beneficial to you for qualifying and eliminating the monthly calculation or minimizing the monthly calculation for student loans. So that's what we can do for student loans. Definitely get rid of the credit cards. And those are basically the two that I see being the most challenging on the credit
and
reports.
It's interesting that you say credit cards. You said credit cards even before you said student loans, and that's because I heard of numbers, when it talks about consumer debt, and they talk about how, as a society, we are at an all-time high with credit card debts. People, and that's typically that's not a good sign for the economy. That's not a good sign, because when people are using credit cards, that means they either are short of funds or they're very uneducated on their finances. So that's definitely scary to think. And as developers, you need to know these things, and you need to have a trusted mortgage advisor on your team, because you would hate, and I've seen this happen. I've seen it happen multiple times where you get 2 to 3 weeks, maybe even a month into the transaction, and now they want to go start digging deep into these student loans, or they want to start digging deep, into medical bills and all of those type of things. They want to start digging once the file is in progress. And then you come back and you think you got a buyer for your new home, but now they don't qualify based on their projected student loan payment. So, you definitely want to have a trusted mortgage professional in your Rolodex for those that may remember what Rolodex were. But definitely you need to have some mortgage professionals on your team for sure. Being that you do have, you have an extended knowledge of the mortgage industry. You get a lot of people now, in the real estate industry, it's almost like the boy who cried wolf or the Chicken Little syndrome. They say the sky is falling, and they've been saying that for like the last 6 or 7 years that the real estate market is set for a crash. Being where you are and from where you sit, you process mortgage applications on a daily basis. You work with buyers. You see things, that not everybody on this side, sees. What would you say are some of the biggest differences between where we are now versus where we were in 2008?
I see that they have eased up. It's not as restricted as it was before in 2008 when things were happening and all the overlays that were being put on mortgage applications.
And you're talking about immediately right after 2008 when they started putting
immediately after, when all the overlays went on there. So it's not as many overlays. It's not as challenging. People just have to be willing. Go ahead.
And I was going to say, explain what an overlay is.
An overlay would be another guideline or requirement that is more than what's standard required for, let's say, Fannie, Freddie, or FHA.
Gotcha.
So it's basically something that the bank put on as an extra. just to basically protect themselves and make sure that they've done their due diligence to see if you qualify.
Gotcha. And banks were putting excessive overlays right after 2008 because
So as of now, it's definitely gotten a lot lighter, but it's still a process.
Gotcha. No, that's good. And as far as, of course, we had a huge foreclosure crisis, during that period. A lot of mortgages were in default, and it was predicated upon just bad lending, and that's what it really boiled down to. It was a lot of greedy lenders and a lot of people that got mortgages really that should not have gotten mortgages. That's kind of that's what I see. That's what I saw, during that time. Again, I was fresh out of college, so I didn't know anything, during that time. I just heard people say that the economy was falling apart, so I believed it. I didn't have anything else to go off of. So, but looking back on it now, because again, I had a family. My sister was a mortgage broker during that time. And yeah, a lot of people that they were giving mortgages to definitely should not have had them. Do you see any type of, because I keep hearing people say, again, we're going to get this high spike in foreclosures and in the coming years or anything like that. Again, granted, none of us have crystal balls. A lot of people expected that after the pandemic, when a lot of people entered into the forbearances and these different programs that the lenders had, because it was extremely easy to do a forbearance during that period of time. And a lot of people projected that a lot of the people that participated in these forbearances were not going to be able to afford their mortgages, after that. Just given where you sit, again, neither one of us have a crystal ball, but do you see any type of crisis even similar to the 08-09 foreclosure crisis? Do you even see anything like that brewing right now?
I don't. And the reason why is because there are a lot of investors out here. And in my opinion, they have found a way to tackle those people that's in those positions of possibly losing the home. Mm-hmm. They've been able to connect with them prior to, in my opinion, that's my personal opinion, prior to them even getting to the level of going into foreclosure, and being able to give them a way out so that the foreclosure doesn't happen.
Right.
That's what I'm seeing happen.
And I think now, because the inventory, I speak even in our local area. I was in a Facebook group, and one of the gentlemen that's very involved in our realtor association, he's citing that we only have about 1 month of supply, kind of on the market, which is very, that's not typical at all to have that low amount of supply. Even if we do get, kind of an influx of foreclosures, I think the market's just going to gobble them up, because you have so many people that are still looking for, good, affordable housing, so for a developer, again, that's looking at, buyers coming through, could be, and we're not talking about your big, large developers. I'm talking about, mom and pop developers, somebody that may be looking to develop their first home, develop a couple homes, throughout the year, somebody like that. I mean, your big builders like your D.R. Hortons and your Lennars and Pulte Homes, those type of builders. I mean, for one, a lot of them have their own mortgage subsidiaries. They have their mortgage and title subsidiaries that they use. So, I mean, they kind of have theirs down to a system. But, somebody that is looking to maybe buy 2 or 3 lots, build some homes on them, sell them, independent. What are some of the differences for an end buyer in financing a brand new home than just going to finance a regular existing home?
With us at First Financial, we have different opportunities. We have our community builder program, mm-hmm. which is a great program that allows for an end buyer or someone just purchasing a home to buy a home up to basically $647,000 and possibly qualify for a grant up to $7,500. There's no PMI with this program, and that's on like an amortized with a 30-year mortgage. So that's a great program that we have that allows for you to put 3% down. We'll give you a grant up to 3%. Well, we'll give you a grant up to 3% of the purchase price. but the max is $7,500, and there's no PMI. So that's a great program that we have for end loan buyers, along with my community builder, my dream builder loan that allows for you to borrow up to 93% loan of value, and then you can do a second loan for 7%.
Mm.
That second loan allows for no interest on the second. So you're just paying whatever the monthly payment is for whatever that 7% is, amortized over 30 years, and no interest. And there's a very low PMI, a monthly PMI premium.
Gotcha. Oh, those are some very viable. Now, are those products, are they geared towards specific geographic areas, or is that open to the entire region?
Geographic areas, but it can be income based. So
Gotcha.
based on the income, where you live, if we look at the income, you may be able to buy in other areas.
Gotcha. No, man, that's very valuable. And as builders, you need to know, as developers, you need to know what different lender, what they have to offer, especially if you're planning to build in certain geographic areas. You need to, connect with your local lenders, to kind of see what they have. As far as paperwork is concerned, when somebody is, looking to purchase a brand new home, what type of paperwork is needed from you all that typically would not be needed for a just regular mortgage?
On an end loan?
Yeah, on the end loan.
Well, it's just going to be basically standard documentation. Last 2 years, W-2s, tax returns, bank statements, etc. Nothing basically unordinary than the standard documents to qualify for a mortgage.
Gotcha. But I'm talking about, from the builder perspective, you all want to see like things like the certificate of occupancy and
on the builders. Yeah. The certificate of occupancy, of course, we're having the appraisal. Once the property is 100% complete, we're good there. And that's basically it for the builders as well on an end loan.
Gotcha. Yeah, but that certificate of occupancy, you have to make sure you have that, because when I worked for the city of East Chicago, we were building homes, and we literally, that certificate of occupancy held us up for about a month on one home because we did not have it. It was built, but nobody did the final inspection. That final inspection is critical. It's key. Have to get that certificate of occupancy. And if it's a subdivision, and there's a HOA involved, a lot of lenders, not all, but a lot of lenders even want to see the insurance of the HOA, especially if there's common area involved and things like that. I've run into that. They want to make sure that the common area is insured, that there's at least liability insurance, things like that in place, for the common area, and if there's a HOA involved, of course, the lender is going to want to see those HOA docs, correct? Like your covenants and your restrictions and things like that. The lender's going to want to know, they're going to want to know, for one, the HOA fee, because that's going to go as a part of the buyer's debt to income ratio. And then they're going to want to know, again, what the parameters or what the rules are for that subdivision. And you can elaborate or add anything onto that you like to, Aaron, if I missed anything.
It seemed like you covered basically all the key points.
Gotcha.
That's going to be required. Yeah, definitely.
Gotcha, man. Well, I will not keep you long. I told you I definitely wanted to get you on and get your view, being that you do have that, local knowledge of what's going on in the mortgage industry. What do you see for the single family housing real estate market in the next 5 years? Where do you see it going?
I see the property values steady increasing. I don't see it falling drastically back to where we were. I feel like it's going to stable out, but not drop. Rates are going to come back down, and we'll be okay.
You think rates are coming back down?
Yeah, I think rates, they got to come back down. When are they going to come down? I don't know. Like you said, that crystal ball, we don't know, but they'll come back down. They always do.
Gotcha, man. No, this is definitely valuable insight. Definitely appreciate your time. If somebody wanted to reach out to you, if it's a builder that wants to reach out to you, because I am also seeing, a lot of builders now offering, and this was stuff that you didn't see during 2020, 2021, even into 2022. You didn't see a lot of this, where builders were offering to cover buyers' closing costs, but a lot of times it's with a caveat. They'll cover a certain portion of the buyer's closing costs, so they'll give a credit for the buyers for their closing costs, or even to buy their rate buy down. But in order for you to do that, in order for you to qualify for that, you have to use the buyer's quote unquote trusted lender, or their buyer or the builder's preferred lender, in order to get those things. So again, it's good to have a lender that you work with. And I'm also seeing builders now, where they're actually buying lower rates. They're actually buying lower rates to offer to the end buyers. But again, you only get those lower rates when you use the preferred lenders, for the builders. Are you seeing a lot of that as well?
Seeing that, but I am learning how to work through it, because as long as you're able to have a good conversation with the builder, the seller, the buyer, and make sure that everyone understands what's going on, we're able to work through it. That's what most of my people right now are doing, negotiating in for buying down the rate.
Gotcha.
In all deals, whether it's on an existing property or a new construction, they're negotiating to buy down the rate, plus possibly assist with closing costs, but definitely focusing on buying down that rate.
Gotcha. Well, man, if anybody wanted to reach out to you, get in touch with you, what would be the best way for them to contact you?
The best contact for me is on my cell phone. You can reach me directly. Just give me a call. My phone number is 219-455-1382. That's 219-455-1382. Or you can always stop in at the branch, the First Financial branch, located in Hammond, the Hessville area, off of 169th.
All right, man. Well, I definitely appreciate you. I appreciate your time. Again, everybody, want to thank you all for listening. Hope you got some valuable insights into the mortgage industry and what your potential buyers would have to go through in order to qualify for mortgages to purchase your end homes. Because at the end of the day, you can say what you want about mortgages. Some people believe in them, some people don't, but mortgages are a big driver in our economy. That's just the reality of it. Mortgages, most people do not have $150, $200, $250, $400,000 saved up. Not saying all, some people do. Some people do, and you have that much cash saved up, you could pretty much, write your own ticket. Again, that's market specific, because 400,000 in California ain't gonna get you much. But 400,000 here in our market, and you got it cash to be able to buy a home, you can get a decent product for 400, 450,000 for sure. So you definitely want to be knowledgeable about the mortgage industry for sure. But I want to thank everybody for listening again. I'm your host, Nick Smith. This is the W.I.R.E.D podcast, Wealth and Real Estate Development, where we talk all things wealth and families, wealth and communities, wealth and individuals through real estate development. This is episode 17. Again, thank you all for listening. Let's go get wired up. Take care.
Take care.
Thank you so much for listening to today's episode. If you enjoyed it, please share this content with someone else who would benefit from it. I'm looking forward to having you with me on the next episode. Now go out and create some wealth and real estate development.